if you think about a stock falling and then rising again, catching the bottom and getting it as it's going up, it can often be harder to buy the stock when it starts to go up.
How would you describe your own version of investing in this way? How do you think that in general funds and hedge funds in particular maybe deal with this situation? Do you think there's more like the first situation or more the second or maybe something in between?
If something is popping up because it's going up or going down, that would be a trigger for me to think about, well, why is that happening? What stocks are benefiting or are suffering from that?
Has the market become more or less efficient with more information and more technology, do you think?
Welcome to Multibagger Nuggets, where we talk about investing in stocks. Your host, Chris Hendricks, from Multibagger Nuggets, also known as From Growth to Value, invites you to join this podcast and the accompanying website, where you get much more content. For the next few months alone, everything is free there now. Today, we have a special guest joining us, Stephen Clapham. He's the author of The Smart Money Method. Stephen Clapham has a background in accounting and worked as a sell-side analyst for investment banks, 2 multi-billion-dollar funds, and he offers professional training consultancy with Behind the Balance Sheet, where he uncovers aggressive and fraudulent accounting methods. He has been featured on the BBC, the Sunday Times, the Financial Times, the Acquirer's podcast, and his own podcast, Behind the Balance Sheet. And today, he joins Multibagger Nuggets for a deep dive into the world of stocks. Here's Multibagger Nuggets, where you hear about tomorrow's winners today.
Welcome to Multibagger Nuggets. Today we have a very special guest, Stephen Clapham. He's the author of The Smart Money Method. That's how I got to know him. And he's got a very interesting background as well. He has been trained as an accountant and started working in equities as a sell-side analyst. He also worked for investment banks and 2 multi-billion-dollar hedge funds, or I should say pounds, because Stephen is British. And also a smaller fund. And then in 2018, he started Behind the Balance Sheet, which offers professional trading consultancy. And his flagship product is the Forensic Accounting Trading Course. Very interesting, I think, for many professionals. He has been featured on the BBC, Sunday Times, Financial Times, Acquirer's podcast, and much, much, much more. And a free tip here, he has his own great podcast, Behind the Balance Sheet. Welcome, Stephen. I'm very excited to have you here on the podcast.
Well, thank you. I'm looking forward to chatting to you, Chris.
All right, let's dive right in. With your extensive experience, what's the most common mistake that you see investors make?
They buy things that go down. I mean, I'm not sort of an expert in, mistakes that retail investors make. I mean, most of my work is done with professional fund managers. And although, we've got an online school, so, if you're interested in educating yourself, we've got the online school is probably 50-50 professionals and private investors. But I tended to do very little with private investors, and really only since I started the training business. And I started doing stuff for private investors because I was concerned when I set the business up that having a business that was entirely devoted to professional investors would be a disaster when the bear market struck. Because training
at the bear market struck for your book there, it fell.
yeah. Well, I was trying to put it in the shop.
I'll show it once more. This is a great book. Everyone who has not read it should, because it's a gem. I have not come across anyone who has read it who said, no, it was okay. Everybody loves it. So
there were some people. I mean, it's funny how you get people that. There's one chap that left a bad review on Amazon and a bad review on Goodreads. A very distinctive name, and I looked him up and I found him on Twitter, and I sent him he followed me on Twitter, so I sent him a direct message. I said, I saw your 2-star review. I just wondered, I wasn't clear why you disliked the book. And he said, I was expecting a book on forensic accounting. And I said, well, there's nothing in the blurb. There's nothing, it doesn't say there's a book on forensic accounting. It's a book about how to invest. And that we didn't quite see eye to eye. But to answer your question, so I started doing work helping private investors to sort of improve their skills. And so, but I've only been doing that for a few years. Until then, my entire career has been spent talking to professionals. And, the mistake that professionals make is they fail to sell. They fall in love with their stocks and they watch them go down. I mean, obviously, investing is a very individual thing. So everybody makes different mistakes. And, the mistakes that I used to make were I always bought too early and sold too early. And, one of the problems, if you're running, a lot of money. So I worked for very large funds and we were trying to make extra return. So we're trying to do special situations. We're trying to make a lot of money out of each position. And in order to do that, you've got to buy things that are disliked for whatever reason. Because once the stock starts to turn, you just can't deploy the capital. You're deploying large blocks of capital. You can only buy it on the way down. And the problem with on the way down is you don't know where the bottom is. And usually you're too early and you can't predict that. And so, that causes a bit of heartache and grief because you've got to ask yourself, so I bought this at 50, it's now at 42. Have I missed something or do I buy more? And the other mistake is selling too early. And I'm always amazed. I've been doing this for a long time. I'm always amazed at how stupid the market can be. It never stops when you get to the right price. It always goes through and goes to, gets to valuations you just can't even make a sense of. You can't understand who is that last buyer. So that would be, being too early. But it's better to be too early if you're a professional than to be too late. I mean, I think if you're a retail investor, you're far better off waiting for confirmation of your thesis in the price action. Buying stuff is going down. Why not wait until it stopped going down?
Why the distinction there between individual investors, let's call it, and institutional investors or big investors?
It's simply a matter of liquidity. Unless it's a very liquid stock. But if you're a professional investor, obviously it depends how much money you're running. I've got friends that run $500 million funds or $100 million funds, and they're not, then you don't really have as much of a restriction. You can wait. But if you think about a stock falling and then rising again, catching the bottom and getting it as it's going up, it can often be harder to buy the stock when it starts to go up.
Yep.
Even if you're running a $500 million fund, if you just say you're running a $500 million fund with 40 positions, you're going to have $10 or $20 million in each position. And if you want to start now and put 10 million or 15 million in, if it stocks start to go up and something's changed in the market psyche, it can be quite hard to get that stock. It's easier to get it when people don't like it or where there's a lot of, normally you go through a period where there's a bit of fighting between the bulls and the bears and the stock kind of, that bottoming out process takes some time. That's obviously a good time to get in.
You only started working with individual investors recently, so you have a fresh look on the differences between, the big boys, the smart money, to call it that way, and individual investors. What are the main differences that you see?
Well, I mean, the smart money was Joseph, my copywriter, came up with that title. And I don't know whether it really is the smart money because, I went to a conference a couple of weeks ago with a bunch of private investors and some of them are really smart. And it's not, smart isn't the province of the professional. And I know quite a lot of professional investors that, I wouldn't have them run my money. They're not all brilliant, obviously. And, lots of people underperform, and particularly at the moment with the concentration in the market. But the interesting thing about doing the podcast is you get to talk to people about, how they look at stocks and their process. And it's given me quite a different insight. And what I've found is that everybody has a very different routine and a very different process and a very different approach. Yeah, we all want to buy stocks for less than they're worth and hope they go up. But how you do that and what you emphasize varies very significantly. So I don't know that there's, the distinction between professionals and private is more about the amount of information you have, the quality of the tools, the amount of resources, and the amount of time. Because if you're a private investor, I know some private investors that are sort of, their professional capacity is to invest their own money. And they do it, 8 hours a day or 24/7. But there tend to be rarer, and most private investors are doing it. It's kind of a hobby or a sideline. They might spend a bit of time, but they don't have the time that you have as a professional. So when I was at the hedge funds, I would spend weeks looking at a stock, not hours or days. Literally weeks. Now, I had a job to do. So, I would spend time worrying about portfolio, making sure I was on top of what's happening in those sectors and industries and markets. And obviously that consumed quite a bit of time. And I would also have to be monitoring other issues. There might be an IPO or whatever. But aside from that, large chunks of time would be spent, looking at one company. And, often I would get on a plane and go to the United States or go to Asia to go and visit the company or go and visit its competitors as part of that research process. But if you're a private investor, very few private investors can afford to deploy that amount of resources, time and money in order to do the work. So I think that, it's more of an effort and how much time and resources you dedicate to the research. I think that would be the primary difference.
Do you think that the gap between professionals and individuals has decreased because of the huge explosion of information on the internet or not?
That's an interesting question. I think that between some professionals and private investors is narrowed because the access to the data is much, much more comprehensive than before. And you can subscribe to systems very, very cheaply and get quite a lot of high quality data, whereas before that would have been the province of the professional investor. But, there's professional investors and professional investors. This afternoon, I'm going to be training a team of quantamental analysts in New York. And these guys they work for a large client of mine, large hedge fund, and they do, they look at alternative data sources. So, there's stuff, the data and analytical skills that are being deployed by the top end institutions, stuff that, didn't exist when I started in the buy side 15 plus years ago. There wouldn't have been that job title. So yeah, in some respects, the private investor has got less of a disadvantage because you can get access to Bloomberg type tools and you've got access to more financial data. You can get the transcripts of the earnings calls and all that sort of stuff that used to be exclusively the province of the professional. But the professional hasn't stood still. And that's the great interesting thing about investing is that you have to adapt to the times. So I dare say at the bottom end of the professional and the top end of the private are much, much closer than they would have been 10 or 15 years ago. But the difference between the top players and the average investor is as wide as ever.
Right. Now, you already talked about this a little bit. You have your podcast and you see the different approaches there. I heard in Patrick O'Shaughnessy's podcast, Invest Like the Best, in a certain episode, I don't remember when, it's already a few years ago, that there have been identified 300 ways in which you generate alpha. So as long as you follow them, consistently, how would you describe your own, version of investing in this way?
I've never heard that expression, the 300 ways of generating alpha, to be honest. I don't, and I didn't listen to that episode. I do occasionally listen to his podcast, but my own methodology, I just set out in the book, this is how I do it. Obviously, what I tried to do in the book was to explain how a professional did it. And, what I was hoping was that a young person coming into the asset management industry, when I started, there wasn't a book like mine. And that was what I tried to do. And I thought that would be very helpful for private investors. I've had a bit of criticism from some private investors that, I don't have a Bloomberg terminal, so how could I do this, But, the process that I follow, I think, is very rigorous, straightforward. I'm not saying that it's easy to execute because it takes time, right? Starting with the numbers, I think, is absolutely essential. And people just don't pay enough attention to the numbers. So even the sell side today has been significantly juniorized relative to when I was a sell-side analyst. And the problem is that, the people that are offering advice on the sell side haven't done the work to nearly the degree of rigor that I would have done when I was at the hedge funds. Not nearly.
But even, your approach, you call yourself in the book, you call yourself a special situations investor, right? So can you speak about that? What makes you a special situations investor?
I was working at large hedge funds and we were trying to make exceptional returns. So I looked for, I think it's not like I was trying to build a portfolio of quality stocks or something like that, right? I was there to try and maximize the returns from the capital that I was allocated. And, you have to fight for your capital. So because all the analysts in the fund, they all have ideas and we all want to make sure that the most amount of capital is put behind the best ideas. And obviously everybody's a different opinion and all that. But, the reason I call it special situations is I didn't really have any particular remit other than to make money. And, we were not risk averse. So we weren't looking to buy Nestle. I mean, I could conceive of a situation where we might look at a Nestle, but, it would have to be that it was so out of favor that something had gone wrong, so that it was so cheap that, because what we were trying to do is we were trying to buy things that were really cheap because somebody had misunderstood something. The stock market hadn't understood that something had changed. So
I have to think of Meta now, like a year and a half ago. Do you agree that was such a case, or?
Yeah, no, I mean, clearly. So, and, we would have looked at something like Meta and watched it as it went down, but we would have, I would have kind of wanted a catalyst. So it would have been when Zuckerberg decided that he wanted to cut costs. In fact, I think, the catalyst there was really seeing Musk buy Twitter and fire half the staff, or I don't remember how many, but I mean, he fired a huge amount of staff. And I think that was a wake-up call to Silicon Valley. Well, we've got all these, we don't need them. They're not doing anything. I mean, Twitter has not been good since Musk bought it, but it hasn't fallen over every day, which you would imagine it would have done without these teams of people. And I think that was a wake-up call that people realized they were too fat and they had too many people not doing very much. And that's been, I think, the reason why Meta has re-rated to the degree it has. I mean, you might argue that the re-rating's been too much, but and also the fact that he seems to have given up on the metaverse. I joke that, Mark was unhappy because Elon and Jeff have got rockets and I don't have a rocket. So, I'm going to have the metaverse instead. And, I'm being facetious, but I think there's kind of an element of wanting, a project
to throw money at, right?
Well, $10 billion a year. I mean, it's not, in the context of Meta's cash flow, it wasn't really that big a deal, but, people just were frightened that it wouldn't be 10, it would be 20. Then I don't quite know what people were thinking about. I didn't really quite understand that. But, that would be the sort of situation we wouldn't really look for things that were quality and fallen out of favor. And we would only look at that if it was a catalyst to believe that the reason it had fallen out of favor was now ending and there was a reason for it to change. Because, with those sorts of situations, it can carry on for quite a long time. There's quite an interesting parallel in the drink sector.
I just, you mentioned something very shortly I want to double click on, and that is the fact that you talked about competition inside of, the big funds, especially. There's a ton of competition and, everybody's fighting for their idea. Do you think it's a good thing? It's a bad thing? Or it's a bit of both? Probably also brings some pressure. So how do you look at it now that you're not, involved in that daily process anymore?
Well, one of my friends used to work for a fund in which they had to compete for the capital and they were rewarded on the basis of how much money they made in absolute dollars. So they were effectively, I was incentivized to say, Chris's idea is really shit. I've got a much better idea. So I could get more capital in my idea so I could make more money. And screw Chris because I never liked him anyway, right? And that's a very, very bad structure. And I think you work best in asset management as teams because there's no exclusivity to a good idea. And just because Jimmy is a banks analyst doesn't mean to say that he doesn't, look at my airline idea and say, I think that I really don't like that idea because X, Y, and Z. And you need to have that. You need to have the ability to discuss things because unless you can discuss things, you can't really get a proper sensation of what are the opposing arguments, what are the risks in the investment? And, it's always the risks that you miss, right?
Yes. So how do you think that, in general, funds and hedge funds in particular, maybe deal with this situation? Do you think there's more like the first situation or more the second or maybe something in between?
Well, I think the situation where you're fighting for capital and you're incentivized to stand on your colleagues, I don't think that's that prevalent now. I mean, I think people understand that that's not conducive to cooperation, and people, believe in cooperation. I'm sure there are funds where it applies. If you look at the pod shops, you get capital based on how well you perform. And if you're performing badly, you lose capital. You're performing well, you get capital. So there's kind of, obviously there's a limited pool of capital. So you're incentivized to not help your colleague because that restricts your ability. But, with most of these things, they're big enough that, and because you help in the hope of reciprocity. So I had a drink with my pal last night, and that stock you're short of, he's long of because he's got this idea. You give your colleague that snippet in the hope that they will give you something similar at some point in the future. I think, people's innate nature is to cooperate. So I think that was a particularly bad structure, but it wasn't, I don't think it was that unusual. I'm not sure how prevalent it would be today.
Yeah, well, I think it's not always the structure, but people also, you just need one bad player and the rest can be influenced by that as well. I have heard about that quite a bit in several funds, but I think it's probably better to cooperate. I totally agree with you. So another contrast, maybe sell side, buy side. Can you explain to, maybe more or newer investors, maybe how the difference is, how big the difference is, etc.?
Well, I mean, there's a clue in the name. The sell side requires a lot of selling. And, I liked my time in the sell side. Great clients. We worked together very closely. In my last job, when I went in, there wasn't a hedge fund in the top 10 client. And when I left, there were 3 or 4 of my clients, hedge fund clients, that arrived in the top 10. And, I worked with these people really closely. And I still am in touch with them today. And, some of them are still clients of mine. And, but when I started, I remember they sent round a tick sheet. And this was a list of the 30 key clients of the firm on one side and the next 50 on the other, and the days of the month. And you did tick, when you call people. I thought that was uninspiring, it's like writing a weekly. So when I started doing my Substack, Substack approached me and he said, "We'd love you to do a Substack, do a weekly newsletter." And I said, honestly, I think I'd rather go to the dentist every week than, then they paid me. So I thought I'll do it. And actually, I now quite enjoy doing it, ironically. But, that.
Unfortunately for your dentist.
Actually, I love my dentist.
Okay.
But that having to sell, my perspective was always that my clients have got multiple sectors to look at. They're not just looking at my sector. My sector would be in and out of favor depending on what was happening in the world. So if you were long only and I thought my sector was going down, there wasn't really a huge amount of point in my calling you. I might call you, once a month, just say I'm still alive, nothing's changed. Calling people up to waste their time just wasn't in my kind of nature. And so that was a problem, the sell side. But on the other hand, you also have the opportunity to interact with the cleverest people in the stock market. And I had some brilliant investors as clients. And that, when you go in and they say, well, have you thought of this? You go in with a new idea and, the more people you see, the better your pitch is because you've refined it and you've heard their inputs. And having that relationship with multiple clients was very good fun. And being on the buy side wasn't as interesting because having relationships with multiple brokers wasn't as stimulating, because and because I was doing I wasn't doing a single sector, I was doing multiple sectors. I couldn't really have very many relationships with very many brokers. I might have relationships with salespeople, but I find it much more interesting when I started in the buy side. After a couple of months, Christ, why did I not do this before? And I'd been offered a job by Stuart Newton, who was the founder of Newton Investment Management, which he sold. And he'd loved some of my research. And he said, why don't you come and work for me? And as I thought about it, and at the time you were better paid on the sell side. And it was a mistake because he said, I'm not sure whether you should be an analyst or a PM. And what we do is we've got psychometric tests. So you go and see a psychologist and he decides what you're best suited for. And I thought, well, I'm not really sure that I want to run money because I like the analysis. And I thought, what happens if the psychologist says, well, actually, you'd be much better PM than you are as an analyst? We end up doing a job I didn't sign up for. And so I I said, no, was it a mistake? I mean, I ended up, a really successful hedge fund. So some years later, and I had good fun on the sell side. So I don't look back and think, I wish I'd gone to work for Stuart Newton. But it probably, had I been better informed and thought about it more carefully, I might have made a different decision. But the buy side and the sell side are very, very different. The sell side, you don't need to make money. I mean, obviously it helps if you do. I mean, I was a successful sell side analyst, not because I knew everything about the company, but because I was very good at working out whether the share price was going to go up or down. And I remember I was up in Edinburgh a couple of weeks ago, and we passed the old headquarters of the Scottish Widows. And I was telling my son, we went up to the Edinburgh University Open Day. My son is considering going to Edinburgh University as an option. And I told him the story. I'd written a sell note on one of the largest companies in the UK. And Scottish Widows owned 3% of the company. So it was one of the top 5 in the FTSE 100. And I was going up the following week to Edinburgh, and they said, no, we can't wait. You need to come up this week. Can you come up tomorrow? So, they were a very big client. So I went up. And I did my pitch, and the analyst was a smart ass guy, and he said, well, don't you think this division has got the best? And he started going through it into all the technical details. And I said to him, honestly, I couldn't even tell you where the factory was. I don't know anything about that division. In fact, I don't really know that much about what this company makes, but I do know that its margins are overstated. Its sales growth is exhausted. And, there were various things. And I said, if you want to know what the company does, you want to speak to my competitor analyst, because he's really good in what they make. He's really good in the widgets. I say, I know nothing about the widgets. I know about this stock. And I went to the airport, fly back down to London, got back to the office much later that day, various other meetings. And the Scottish Widows had placed their 3% through another broker. And I never forgave them for that. I still remember it all these years later.
Yeah. And maybe it's a good segue into another subject that I wanted to touch on. You already mentioned it, forensic accounting. How would you describe to people what forensic accounting is?
What I do is a sort of simple version, but I called it forensic accounting because I was originally asked to build a forensic accounting course by Stuart Investors, which is a 50 billion odd global stroke emerging markets manager with offices in Edinburgh, London, Singapore, and Sydney. And they were concerned in 2018 that they'd recruited a lot of people since 2009, and those people had only ever seen the stock market go up. And they said, can you build us a forensic accounting course so that people understand the risks? And I went to the British Library. British Library has every book ever published. Well, I say it's got every book ever published. There's 1 or 2 investment books that have become very rare and very valuable, which have been stolen from the British Library. But I logged myself in the British Library for over 6 weeks, and I studied I studied a lot of frauds, actually, because what I was trying to understand was I'd never built a training course before, and I'd never really done this type of research. And what I was trying to work out was, what are the patterns that you could look for? And obviously I'd done some of this in my work, but what I ended up doing was I found a whole lot of examples of frauds. And then from my past experience, lots of examples of companies engaged in earnings management. And one of the biggest issues that I see today is that almost every company, from Apple down, is engaged in presenting its earnings in a more favorable light than they would otherwise be. So they're goosing the earnings to juice the growth, to make themselves look more valuable so that they can get their stock options and, make more money. And, Charlie Munger said, show me the incentives, I'll show you the outcome. So, it's no surprise if you incentivize people on earnings per share growth and pay them lots of money if they achieve it, they'll mess around with the numbers. And so my course, which is a 1-day course split into 2 half days, goes through the first half day we spend on the theory, how do people cheat? Why do they cheat? How do they cheat? Lots of theoretical ways. And then the second half of the course is engaged in a practical understanding of how you detect that. So the theory and the detection. And I do this course, I do this course in a Zoom-based format. Now, I have quite a few small, normally I go into big institutions or institutions with a dozen professionals and deliver the content. But I also do it over Zoom as a cohort-based course. So 8 weeks, an hour to 90 minutes each week. And we do it over Zoom. And people from New York, California, London, Frankfurt, Sydney, people all over the world. And we go through like all the accounting red flags that I use. So there are like 9 key red flags that I use to detect companies that are cheating. And then we go through all this about how does this all manifest itself, and how can you check the companies? It's basically trying to work out how good quality the earnings are. Because what people fail to appreciate, in my view, is that the valuation and the accounting quality are joined at the hip, right? So you can't separate the two. So I was asked to do a valuation course by multi-trillion-dollar who felt that they had their forensic accounting sorted because they got a team in India. And we did the advanced valuations. We're looking in some detail about how to calculate rolling enterprise values. It's quite complicated, difficult stuff. But, the questions all came back to, well, what about the quality of the accounting? And even so, even though we were trying to leave the accounting to one side, we couldn't, because, at the end of the day, if you're exaggerating your growth, it's very dangerous to the investor. The company's exaggerating its growth because you tend to pay up, and you shouldn't. So you need to understand, how the earnings are calculated.
And if you, of course, it's your course, and that's much more extensive. But if you would have to, highlight 1 or 2 huge red flags, what would those be?
Well, there are 3 things that I always tell people to look. One is working capital ratios, because if the working capital ratios look odd, it might not be that the company's juicing its earnings. It might just be that the company's having a hard time. So if you see, for example, that the debtor days are lengthening, it might simply be a reflection of the customers getting the upper hand in the bargaining negotiation. It might be that the company's bringing forward its earnings, recognizing revenue a bit early. Might not be that at all. It might be the company might be clean. But what it's telling you is that something not quite as high quality. And similarly, rising inventory days might not be that you're cheating. Might just be the customers don't want your product. But those sorts of things are very important. I also like to look at margins and, comparing the margins with the peers and trying to understand, why is this company, it doesn't appear particularly good quality, reporting such high margins? Or if it has, what is it that enables it to achieve such high margins, and how sustainable is that? Might not be, these aren't necessarily forensic accounting questions per se. They're actually questions that, go to the heart of, well, what's the business model and how good is it? There's a whole list of things that I look at. They're called forensic accounting, but I'm not sure that they really are. I think they're just doing the research to, a slightly deeper level to make sure that you don't end up owning something or overpay. This really helps you to avoid overpaying for something that's not quite as good as it appears. Or, many of my clients are quality investors. And what they're trying to do is they're trying to avoid owning a stock and carrying on owning it when it looks like the growth rates, carrying on at exactly the same level. But actually what's happening is the growth rates dipped and the accounting quality has dipped. So that, it still looks like it's the same growth, but it's not.
Yep. Do you think it's becoming a real problem now? Like you're saying, more and more, earnings are, let's call it, juiced these days. Do you think it's a real big problem, or do you think it was to be foreseen? Or
I'm not sure to what degree it was foreseeable. When I was building this course, at the same time, for reasons I won't explain, but I was going around a bunch of mid-caps in the UK, going to their analyst meetings. And every analyst meeting I went to, I found an example that I used in my forensic accounting course. So the course got like 150 real-life examples of people cheating. But what was quite fascinating to me was I did not go to a single UK analyst meeting that did not give me something from my course. Now, I can't hand on heart say that that's, unique, because I'd never gone round a series of analyst meetings while I was building a forensic accounting course. So, when you're carrying a hammer, you go looking for nails, right? So there is that. But I'm absolutely convinced that we're at an all-time high in cheating. And, I've interviewed somebody the other day and he didn't like me saying companies are cheating. because he worked for a big bank and he thought that would be insensitive.
They call it optimizing then, right?
Optimizing, or yeah, whatever you like to call it. I mean, companies are taking a more aggressive attitude, and in a sense, you can't blame them, right? Because if you're in a sector and you see your competitor doing this, if you don't follow them, you'll be the one that you'll be the one that's got the lower share price growth, and you'll be the one that's getting criticized. And people are human, right? I mean, and we saw this very clearly with the big tech companies and the server lives. Now, you could argue that the server lives are absolutely correct, right? I mean, I don't have any technical knowledge of the subject, but when you see a company revising the depreciation life of the server, not once, not twice, but 3 times, you're going to have to say, well, surely, or even if you do it twice, I think one did it 3 times, but a couple did it twice. So, well, if it was 3 years and you moved it to 4, why do you now feel the compulsion to move it to 5? What's changed? When you looked at it and said 3 years is too short, we're unfairly penalizing ourselves, why didn't you go straight to 5? Because that would be a lot, that would be, if you were doing the job properly, and these are tech companies, they should surely know whether life is 4 or 5 but it's not 3. To me, that's symptomatic of companies where they see their competitors and they feel they have to follow suit. They might be absolutely right, but what I don't like is didn't like them changing their mind twice. I don't think that's acceptable. To me, that's not acceptable, because I'm relying on the finance department to work out how long the thing lasts and to do it properly, and not to change their mind every 6 months.
Yeah, and I agree. They all did it, right? At least twice. So maybe to inverse the question, are there any companies that come to your mind of whom you say, like, those are examples?
Sorry, you mean good companies?
Yes.
I mean, Berkshire Hathaway seems to be pretty clean. I would imagine it would be pretty honestly expressed, but they give far too little disclosure, and I would really criticize their disclosure. Microsoft used to be very high quality, but it's been engaged in the servers as well. Microsoft done a number of things that make me think it's lower quality than it was, although relatively it was up here, and it's probably still higher than most, but it's definitely been engaged in some more aggressive practices than it ever used to.
One of the things that I heard in a presentation recently was that, and I also saw in your book that one of the many resources you used for ideas was screeners. And somebody, made a presentation and said, screeners don't really work because everybody uses them. And secondly, special situations also don't work that much anymore because there are much more investments in ETFs, and there's not enough capital to turn it around. So how do you think about those two ideas?
People are entitled to their opinion. I can tell you that I don't go screening for low price to book stocks, right? I mean, the screens that I use are very much more sophisticated, and I don't use them to find stocks. What I use screens for are to reveal patterns in the stock market. And so if a company appears on several different screens, then, it gets bumped up my priority list. And I would be looking at, multiple factors, but one of the factors I'd be looking at would be momentum. So, if something is popping up because it's going up or going down, that would be a trigger for me to think about, well, why is that happening? And I would be using factors and all sorts of quantitative tools to just try and work out what phase of the stock market are we going through, and, what stocks are benefiting or suffering from that. And that would be, it's not just sort of screening. I've got a certain amount of sympathy to say, screening for low price to book isn't going to work, right? I mean, everybody can see that. But you can do screens in a much more sophisticated way, and you can look at not just valuation factors, but combinations of valuation factors, momentum factors, fundamental factors. And, when a stock is appearing on multiple, giving you multiple signals, that's usually a trigger for further investigation, because it's a way of identifying change. I was doing global, so I don't know how many stocks were in my coverage universe. Thousands. I mean, obviously things had to have a certain amount of liquidity. Otherwise, I wasn't if it wasn't liquid, I wasn't interested in it. And then there are certain sectors that I just didn't do. So I didn't do healthcare, biotech, because I didn't understand it. I didn't do financials. I didn't, there's a whole load of sectors that I didn't get involved with. And then there's certain geographies that I would favor and certain geographies that I didn't like. I've never liked investing in Australia. Apart from the fact that, it's simply, if something goes wrong, it's two long plane rides away. And it's, really, it's other side of the world. And if you want to investigate anything, you've got to do it at nighttime. So it's just, practically speaking, the hurdle for an Australian stock in my portfolio would always be higher than it would for an American stock. Just those sorts of respects. Never say never, but it wouldn't be that high. So I was looking, even with those sorts of constraints, I was still looking at thousands of stocks. And how do you work out what might be interesting in thousands of stocks? I mean, some of it is bottom up driven, some of it fundamental driven, and some of it would just be, I wouldn't necessarily even run the screens myself, but brokers would send me screens. And some of those screens would be quite clever. There was a guy in CLSA who used to, look at an event and then do a screen around that event. And, I'm trying to think of an example, the Fukushima nuclear disaster. And he would look at, stock price performance in Japan since that event and stock price performance in other markets. And, something like that, you can say, oh, well, look, all these German stocks falling a long way, except this one. And then you ask yourself, well, why is that? So it's that, it's not just the sort of very straightforward price to book, which is, it probably wouldn't work.
Yeah, I totally agree there. I think that it's still the work that you put in, the manual work that will make the difference, not the screener, but, it can, put names on your idea list, right?
I mean, I wouldn't have very many positions, but I'd have quite a long watch list. And, you always want to have that refreshed because you want to have a steady pipeline of new ideas so that when you decide you need another stock, you can find a good one. If you only got three possibilities, they're all shit, then, you're not going to make any money. If you've got 300, it's too many. But if you've got 20 or 30, you can go through and you usually find something good. And I believe that you're much better off sourcing ideas from a wide variety of sources because then you're much more likely to get a good one. If you only get your ideas down the pub from your mates, that's probably not a good strategy for performance.
In the book, you also talk about that having a different outlook on profits, future profits is one of the situations you really pay attention to. How do you see that? How do you have a better insight than the consensus?
Well, no, I mean, I never understood people that spend all the time worrying about valuation. I would never buy a stock because, it's always traded on, 15 to 18 times and it's now on 13 times because I've never found a situation where there wasn't a reason why it had gone from 16 and a half to 13. There's always not. The reason might not be a good reason and you might believe, the market's got that wrong, it's going to revert. But mainly when that happens, it's justified. Stock market is not stupid. So what I used to spend my time doing was identifying opportunities where the stock market had got the profits wrong. So the consensus estimates were wrong. And it's a very different strategy. And obviously it's not a strategy that everybody can deploy because it means you've got to be able to do a profit forecast. You've got to be able to do a cash flow forecast. And you've got to have some idea what's driving revenue and costs. And it requires more work. But it's a far more reliable way of picking stock opportunities because as long as your analysis is accurate, the stock price will follow. It might take, it's always very difficult to know how long it will take. So I laugh about people that talk about portfolio turnover because your portfolio turnover isn't a function of what you do. It's a function of what the stock market does. So if the stock market is very quick to spot the, 3 or 4 ideas I've got going, well, I'm going to sell those ideas and replace them with something else, right? If the stock market is very slow, I'm going to sit there because I'm confident over time the stock market, once those earnings are delivered, the stock market can't ignore it. So, the consensus, if the consensus estimates don't change, and then the stock price comes in and the earnings are up here, the stock price won't carry on there. It will go up to reflect earnings. So, as long as you're confident about that, then you'll get it reflected in the stocks you own. And that, it wasn't through any sort of grand design. When I started in the buy side, I didn't have any idea how to do this. This is how I developed the technique over time, was that this was the most reliable way of making money.
And does that also mean that you never hold stocks for the long term?
I'm not able to talk in detail about, the positions at the funds, but, we had disclosable stakes in companies, and, we would have disclosable stakes year after year after year, even in a hedge fund. Because if you find a good stock and it's going up and it's doing the right things, it's in the right area, then, why not carry on running the position? No reason why you would want to get out. I mean, the idea of holding a stock forever, Warren Buffett, I'll never sell. Well, I don't want to be critical of Warren Buffett. I mean, he's obviously an amazing, not only a brilliant investor, not only a genius, not only a fantastic communicator, but done an incredible amount for the world. I mean, literally for the world. I don't mean to criticize him at all, but owning stocks forever doesn't work. For the vast majority of people, for Warren Buffett, he's decided to do that because he wants to devote his considerable brain power to finding the next thing. And, selling Coca-Cola would just mean that you need to find something else. And he would need to find something else that can replace that can go up by 30% to compensate for the 20-something% capital gain that he's had to pay tax on. So, I'm not criticizing for that, but, for the vast majority of people, owning a stock, look, what's Coca-Cola done? In the first 20 years they owned it, it went up, 10, 15 times. I've forgotten what the number is. Since then, what's it done? Underperformed the market, I would wager. I don't know, but I would bet it has. Why would you want to own something that does nothing for 10 years? Why would you want to own Microsoft, post-tech bubble, where it went sideways for, I think it took 15 years to recover the share price?
Well, if we count from the top, that's correct.
Yeah, well, earnings went up every year. So I just think, you have to be pragmatic, and you have to be long-term, because if you're short-term, you just get whipsawed around by the stock market all the time, and it's not very good for your nerves. It's not very good for your portfolio performance. I mean, I think, patience is a very important quality for investors to adopt.
I think that if you look at Warren Buffett, I think people often misunderstand. They always say that he doesn't sell, but he does, of course. He just says that his favorite holding period is forever, but that doesn't happen that often. He only has a few, which he has had like several decades. But, there's turnaround there as well. I want to throw up a counter argument here. I've seen quite a bit of studies that show that hedge funds, or funds in general, that have a turnaround of 100% plus do much worse than funds with 50% plus turnaround, and even, the best ones are 30% turnaround. So what do you say about those studies?
I couldn't comment on those studies. I've not seen them. I don't think that, a fund that turns over 100% in a year is got a particularly high turnover. I think it's perfectly easy to do that. First of all, you don't get everything right. Second of all, even if you got an investor like Terry Smith, who I've got I've got a great deal of respect for. I think he's a very, very good investor. I think he's very smart. And, he says, we want to hold things basically forever. And he sold 3 stocks last year. He sold Amazon incorrectly because the new CEO said that he wanted to become much bigger in food, supermarkets. And Smith rightly thought that was a stupid idea and got out. He sold Adobe because they stupidly offered, was it $20 billion or more for Figma. 20 times revenues for Figma?
Yeah.
It's a really stupid deal. And then the deal fell through and the stock went up.
Correct.
Even an investor with a very long time horizon, you sell things, not necessarily even for the right reason, but you sell things because you think that there's a risk that you aren't prepared to take because management are changing strategy or they're doing a stupid deal or whatever. And so, turnover is not always by design, right? You can have a very long-term perspective. And, is 30% the right number? I mean, I don't know anybody that manages their money. I don't know any decent investor that thinks about the portfolios or no. It just is not a factor. Terry reports on it because it's one of his marketing features. He says, we have low turnover, therefore you'll pay less commissions. Screw the commission. I mean, you know, the spread and the commissions, they're noise. If you own the wrong stock, if you made a mistake, you should get out and show me the person that doesn't make a mistake.
Well, in that respect, I really liked, you know, the speech that Roger Federer gave, and he said that he had won in his career 54% of the points, which made him this huge, you know, champion. I think that is a real good comparison to the stock market, that you can be a huge winner with just like 54% winners.
I'm not sure that you can be a huge winner in the stock market with 54%. I mean, you'd need to turn over quite a lot to be that, to do really well with. But, you know, I know very, very good investors that reckon that's their win rate. One particular guy said that to me, and he manages, you know, several $1 billion hedge fund. He's a billionaire himself, and I said, really? And I never really quite believed them. I mean, obviously he must be very good at position sizing, because if you only get 54% right, you know, got to make sure that those 54 are a lot bigger than the 46. But I think it's quite hard to do well with that low a win rate. But I don't know. I mean, I've got a much higher win rate. I mean, I still make a lot of mistakes, but I've got a much higher win rate than that.
I also think it depends on your, you know, if you're more of a long-term investor, you know, the compounding can, of course, work for you as well.
I don't agree. I mean, compounding the share price can work if you have high turnover and have a lot of winners. I mean, it's not, you know, this
also possible, but you will not have, like, you know, an Nvidia, for example, like, you know, a 10x in, what is it, a year and a half, 2 years, something. So
quite a short time, and that's quite an unusual circumstance.
Correct.
That do that. I mean, you know, will you make more money owning something that, you know, is a 10 bagger over 7 years, or, you know, buying something goes up 50%, sell it, buy another thing that goes up 50%, sell it? I don't know what the maths are.
Yep.
What I do know is that the 10x stocks tend to be quite rare. And yeah, you might get a few in your career, but it's easier to identify the things that have got, they're cheap, but not excessively cheap. If you spend all your time looking for 10x stocks, then you might spend a lot of time on fruitless pursuits until you find one. And then even if you found one, you think you found one, you're not guaranteed to be right.
You're never guaranteed to be right in the stock market, right?
What I was just trying to say was you need to have a portfolio. So you might have some things that you hope are 10xers, and you might have some things that you think they're never going to be a 10xer, but I'm pretty confident I'm going to make 40% and, you know, in a reasonable time. And you might have some things where you've got smaller positions and more moonshotty. It just depends on how you run your book, right? How you run your portfolio.
So next to Multibagger Nuggets, there's also Best Anchor Stocks, which I run with my co-author, Leandro, and he had a question for you as well. Has the market become more or less efficient with more information and more technology, do you think?
Well, the market's always been reasonably efficient. I mean, I think it's harder to make money today because there's more capital, there's more resources, there's more human capital, there's more effort being deployed than there was 25 years ago, say. So, you know, but even, you know, when I look back in certain periods, I think that was easy. It wasn't easy at the time. You were trying to make 15, 20% per annum, and it wasn't effortless. You know, it was still hard to, you know, you still made mistakes, you still got things wrong, things still happened that you didn't expect. You know, the stock market's got a way of making sure that you're kept humble, and without question, it's more complicated, more difficult, and it's less intuitive today because, you know, I think one of the big problems is the rise of passive has made price discovery more opaque. And you then have a lot of much shorter term players. So you've got the high frequency traders, you've got the algorithms, and you've got the pod shops, and the pod shops deploy a lot of capital. So when you were going in to set results, historically, when you were going into set results and you saw the shares weaken, you would have assumed from that there was, you know, a big seller who knew more than you did and was trying to lighten up ahead of the figures. Now it could just be because it's in some ETF that's gone out of favor, or it could be the pod shops have got a story. Now they might be well informed and smart money and might be short of it for a reason. But, it's just a noisier market. And the traditional way of working, David Einhorn, I think, is very interesting in this. He says that, what I used to do is very similar to what Einhorn used to do. We were trying to be ahead of the big long-only institutions and trying to find opportunities. So we find things that, the stock market got the forecast wrong. We would buy it. Then the earnings would start to come through and the long-onlys would come in and push them up. Now there's, lots of stocks where there's much less coverage, where there's much less interest. And, he talks about companies where, it doesn't matter if they miss earnings, but nobody's looking at it. I think that's a bit of an exaggeration, but
I understand what you say.
The key is you have to operate in today's market. You can't just do what you always used to do.
And that's actually a perfect segue to my next question. If you look back at yourself, like 10 years ago, and maybe even to the start of your career, how have you evolved over time?
Well, I think, with all these gray hairs, the ones I've got left, the mistakes teach you. I wish I'd never made the same mistake twice. You do make the same mistake twice, but you tend to be more wary of things you got wrong in the past. I think there's lots of really, really smart young people. I don't think the age necessarily, the experience necessarily gives you an edge. I'm much less familiar with technology. I'd be much less familiar with, the use of artificial intelligence. I'm building a free course, a giveaway course. And before I came on, I was using AI to help me write it. I wouldn't do it for courses that I was building that I was selling. But this is, a course to help people. And I don't want to spend weeks building it. I want to do it reasonably quickly. And so I'm giving it away. So I thought, I'll see what ChatGPT says about this subject. And I'm quite surprised at how you could put it in and it would be obvious that it was written by a robot. But if you take it and say, okay, I'm going to rewrite, I've now got a script and I'm just going to rewrite that. And I actually used two, merged them and then changed it. And it was quicker than me sitting there writing it from scratch because I was trying to write about, this is what this market looks like. And I'm not particularly expert about it. So, it was quite interesting. But there's all sorts of things that younger people are better at, right? So my kids could probably have done that faster than I could have, almost certainly. So I think, you do learn. It's ironic that I've been doing all this work on forensic accounting, teaching people. I'd never spent any time worrying about my process. When I wrote the book, that was kind of formalizing I'd done in my head, and probably the act of writing the book would have made me more structured in my approach. And then building the forensic accounting course and thinking about all these things, it made me much, much better investor and much better at working out. And so now, I have a number of clients, big hedge funds, some big long-only funds who will engage me to look at stocks and say, can you look at this and check the accounting's all right? And I'm better at doing that. I'm more accurate, faster than I was when I was doing it professionally.
Mm-hmm, mm-hmm. I talked with Vitaly Katzenelson a few weeks ago, and I said, I learned to trust my gut. And he said, yeah, you should trust your gut once you are experienced, because, if you do that without the experience, you'll make mistakes, one after one. Do you agree with that? Do you see that as well or not?
Well, I think what's very dangerous is if you feel uncomfortable about something, to ignore that feeling.
Because that's what we were talking about.
You might be right, you might be wrong, but if you're wrong, you really just kick yourself. I felt uncomfortable. Why did I carry on? I agree with him in that respect. It's more a psychological thing that you just don't want to end up thinking, I knew I shouldn't have done that. I knew that relationship between the CFO and the CEO, it really didn't look right. And why did I ignore what I knew? You should always listen to your feelings, I think. I don't know how long you need to have been doing it before you've made enough mistake, you feel uncomfortable at the right time.
Yeah. Our last question to round things off. Of course, there's your great book, which everybody should read, The Smart Money Method. But are there any other books that you have really enjoyed lately? Investing or not investing?
Investing or not investing. Shane Parrish, his book, Clear Thinking, I thought was very good. I'm reading a book at the moment by Dan Davis about accountability machine, which is about mistakes being made by organizations. I've also been reading a book by Adam Grant, which is, I've forgotten what it's called, but it's about giving. A really nice book. So it says, if you're classifies people into givers, takers, and matchers. And he said that givers do better than you would think. I've been really enjoying that. It's a really well-written book. I haven't finished it yet. Give and Take, it's called. What else have I got in my book stand? I mean, I've got a pile of books that is about, it was about a meter high. It's now about 70 centimeters high, but there's 2 70-centimeter piles. I'm trying to get through them. And actually, I'm going to publish what I've read in the first half of the year. But a lot of the books that I've read have been related to podcasts. So I've had less of, I'm inviting the guests. So, obviously I've got interest in what they're saying, but I've had less discretion to some extent because I can't have a guest in my podcast that's written a book and not read the book. I think that would be very bad practice. Another book that I read that I really enjoyed this year, I'm always a bit behind, is
Behind the Balance Sheet, right?
Material World by Ed Conway, which talks about different commodities. And it was very well written. I mean, it's truly it's a big, heavy book. All these books are big, heavy books, and you don't want to carry them around.
Yes. Well, yours is easy to carry around. And I just want to emphasize again that your podcast is fantastic as well. I know many people who listen to it and really enjoyed it. So I think everybody listening to this should subscribe to your podcast as well, Behind the Balance Sheet. Thank you very much, Stephen, for this great conversation. And I wish you all the best with your podcast and with the courses, of course. Thank you very much.
I hope you enjoyed this content. None of this is financial advice, so don't buy stocks only based on this information. Chris and the guests may have positions in the stocks they discuss.